Welcome to the channel. I'm the Swedish dividend investor, and I got a question from a subscriber. At least I think you are subscribed. If not, what are you waiting for? Hit that subscribe button and turn on notifications. So, KLK007 asked me, what about iShares Core EURO STOXX 50 distributing in my video Finding the European SEHD? And I thought it sounded like an interesting ETF to look into. As I said in the video, I didn't include lower yielding ETFs, since I wanted the ETFs to be as similar to SEHD as possible, with SEHD yielding somewhere in the range of 3 to 4%. Everything below 3% got excluded. Anyway, KLK posted their dividend stats, so I decided to take a look into it. In this spreadsheet, I wrote down their dividend history and growth rates. Their current yield is 3% as of the making of this video. And not surprising, we see the same old here. A very spotty dividend track record. I started with 2015. We can see a huge increase in 2016, 15.13%. But in 2017, a slash of almost 10%, and so on until 2020, where the growth picks up. We can see the compounded annual growth rate until 2024 was impressive, 18.58%. But looking at their 5-year CAGR, it's at a reasonable but not impressive 5.32%. However, if you bought in 2015 and held until now, your dividend would have grown with a total of 52.97%, which is very nice. That is, if you had the balls to hold during all those cuts. So our job today is to figure out if it's worth buying this ETF. Let's just go over the holdings real quickly. We got ASML, SAP, Siemens, Louis Vuitton, Allianz, Schneider Electric, TotalEnergies, Sanofi, Deutsche Telekom and Air Liquide. In falling order, we have the sectors here: finance, industrial, tech, consumer cyclical, consumer defensive, healthcare, communication, energy, raw materials and utility. The countries are as following: France, Germany, Netherlands, Spain, Italy, Finland and Belgium. Alright, is it reasonable to use the 3-year CAGR to value this ETF? I mean, it is possible, but not very probable that growth would be sustainable. I tell you what, let's use both the 3-year, 5-year and something more conservative, just to see where we land. So we head to our valuation page. I've gone with the dividend of 2024 since we have data for the whole year. I'm using a 10% discount rate. This is our required return. Let's use the 5-year CAGR for the normal case. Let's go with 5.3% growth, and since the yield is somewhere around 3%, let's use that for our terminal multiple. We enter 33, and to check we are right, we divide 100 by 33, and that's 3% yield. That is assuming growth of 5.3% for 10 years, and the yield of the ETF is 3% at the end of the calculation. Before revealing the fair value, let's do the best case and use the 3-year CAGR, something I wouldn't recommend by the way. But it could be good to show you guys why we use conservative numbers when doing valuations. Let's use 18% and a yield of 2.7% at year 10, so 37 as a terminal multiple. Next is something I would use. Let's do this in the worst case. I've gone with 4% growth and a terminal multiple of 33, so 3% yield at year 10, just as we did for the normal case. Let's go through the numbers. Normal case, fair value 42.15 euros. Best case, well, here you can see what happens when we do exuberant valuations. Fair price of 117.12 euros. Now, like I said before, is it a reasonable growth number? No way. A more fair assumption would be to use a lower number, and if the numbers match and they grow faster, that is just a bonus. So, for my case, in the worst case section, we can see a fair value of 38.22 euros. So what does the market price in? If we change the growth rate to 7.5%, still using a 10% discount rate, we can see the value is in line with today's price, meaning that growth is expected for a 10% return. Let's change the growth to 5.3% again. And if we just change the discount rate, we could see what we could expect if we were to invest today, with the assumption of 5.3% growth for 10 years. So let's change the discount rate to 8%, and we get a fair price of 49.45 euros. And we could expect an 8% return per year at today's price. So let's change the growth to 5, 6 and 4 for each case, and change the discount rate to 8%. We would need to buy below 49.32 euros to make 8% per year. And that's pretty much in line with today's price. Conclusion: it's fairly valued for an 8% return, but a lot of things need to fall in place for the return to get higher. Solution: take a look at FEUI or SPYW instead. The holdings, countries and sectors are very similar. The dividend yield is higher with 3.6% for FEUI and 3.5% for SPYW. And if we take a look at their valuations, I've gone with 5% for normal, 6% for best and 4% for worst case. Discount rate 10%, and for the normal and worst case I used today's yield as a terminal multiple, 28, which equals around 3.5% yield at year 10. And just a bit higher for the best case, so nothing crazy. And we'll land somewhere around their current price. I mean, look at SPYW, it has the better valuation. But if I would want higher quality, I would go with FEUI. So I would either wait for a better opportunity with EUROSTOXX 50 or go with FEUI or SPYW. But by the time this ETF drops, we could surely get even higher returns from the others. I hope you got some answers. If any of you guys have a stock or ETF you want me to take a look into, drop it in the comments. I sometimes do valuations on companies that don't pay dividends, but since this is a channel about dividends, try to make sure the asset has distributions, and I will make a video about it if I find it interesting. That's it folks. Remember to support the channel by hitting that like button. Subscribe if you haven't already, and drop a comment down below to tickle the algorithm. I'm the Swedish dividend investor, and I will see you in the next one. Stay smart, stay patient, and keep stacking those dividends. Ha det gött!